China is targeting 5% GDP growth again. Debate is intense on how it'll get there. Gold and Bitcoin just hit record highs again. Australian exports are helping GDP growth. South Korea's factories are humming. There's new inflation pressure in the Philippines, but less deflation in Thailand. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Krystal Tan looks at how Asian central banks are bracing for the Fed's first rate cut.
Going to be a tricky balance between, external considerations and also the domestic pressure for rate cuts. I think in some places, domestic considerations may hold greater sway.
But first, in 5 and 5 with ANZ, China has set a 5% GDP growth target for 2024. That's above market consensus, but disappointed some traders who want larger fiscal stimulus. Chinese Premier Li said meeting the target wouldn't be easy and that China needed to make structural adjustments to its growth model. In global markets, the S&P 500 is down 0.8%, while gold hit a new record high. The Aussie and Kiwi dollars were trading flat at 65.08 US cents and 60.9 US cents respectively at 5 a.m. Sydney-Melbourne time. ANZ senior China strategist Xiaopeng Sheng says China's GDP target sparked questions of how much extra fiscal stimulus will be needed to bridge that gap between the market's expectations for growth of about 4.6% and that 5% target.
We still expect the monetary easing can be helpful in 2024 to mitigate the gap between the official target and the market expectation. We still maintain our 20 bips cut to the policy rate this year for the monetary policy. The next time window for interest rate cut will be in April, when Q1 economic data will be released.
Number 2, markets are expecting Australian GDP data today to show December quarter growth of 0.2% and annual growth of 1.4%. Now that will be down from 2.1% in September. ANZ Head of Australian Economics Adam Boyton says the RBA should be comfortable with anything in the 0.1 to 0.5% range for quarterly growth. ANZ is forecasting 0.3%.
What's driving that across the expenditure side anyway is very modest or weak growth in household consumption. With that, we have up just 0.1. Business investment is up 1.5% and continues to be a source of growth for the economy. And we think net exports, in fact, we know from data that came out yesterday that net exports will contribute 0.6 of a percentage point to growth. Offsetting that, we also know from data out earlier this week that inventories will be a big drag on growth.
Number 3, South Korea's GDP grew 0.6% in the December quarter, and activity was up 2.2% from a year ago. This was the same as an advance estimate. But ANZ economist Krystal Tan says the mix has changed.
Manufacturing and services activity were slightly stronger than previously anticipated, but this was offset by a weaker than expected construction sector. So the big picture remains the same. The export-oriented manufacturing sector will increasingly drive growth, particularly on the tech front, and this will help cushion softening domestic activity.
Number 4, inflation in the Philippines was stronger than expected in February at 3.4% annually. That was above the 3% market consensus. Krystal says the country's central bank, the BSP, can be patient before cutting rates in Q4. Assuming, of course, the Fed moves earlier.
So the jump was driven by higher food and transport costs, whereas demand-side pressures have softened as reflected in a moderation in core inflation. But now, with the risk to inflation still tilted to the upside due to the potential adverse impact of El Nino on agriculture production, the BSP is set to maintain a tight policy stance for a while yet.
Number 5. Meanwhile, deflation in Thailand wasn't as low as expected. The annual CPI fell 0.77% in February, just shy of the market pick of negative 0.8%. It may take until the end of the year before inflation rises towards that lower end of the Bank of Thailand's 1 to 3% target. Here's Krystal.
Looking ahead, with the government's energy subsidies still in place, headline inflation is still going to remain negative in March. Further out, though, the diesel price cap could be raised, given that the oil fuel fund is under pressure. And another watch point is if the electricity subsidies will continue post-April. But even without shifts to these energy subsidies, inflation in Thailand is set to turn positive in May on base effects.
Krystal Tan there, who we stay with for our bonus deep dive interview. She says Asian central banks are all waiting for greater certainty on when the Fed will start easing.
If you have a pivot by the US Fed, that will increase scope for Asian central banks to embark on their own easing cycles. He said that degrees of freedom for Asian central banks to pivot before the US Fed is going to be guided by both the strength of the US dollar and also the individual external positions across the various Asian economies. So an economy that has, more scope to fight potential currency depreciation pressures would arguably be in a better position to prioritize their domestic conditions. So I think there are two useful external health metrics that we can look at. One is the current account positions, and the other is reserve adequacy. So when we have a prolonged phase of elevated US interest rates, economies with improving current account dynamics will have larger buffers to accommodate potential capital outflows. So on this front, the current account in South Korea and in Thailand have been on an improving trajectory, and we also see further gains on the cards thanks to, in Korea's case, a semiconductor revival, and in Thailand's case, a tourism recovery. So this means that their external resilience is going to be better going forward than compared to, say, a year ago. Whereas in contrast, if we look at external buffers in Malaysia and Indonesia, it looks like things are narrowing there. In Indonesia's case, the current account has slipped back into a deficit as earlier gains from buoyant commodity prices have reversed. And the other one is the Philippines, that also stands out as having a relatively weaker external position in that its current account deficit has remained quite wide and prospects for a material improvement in the near term is quite limited. Now, the other metric we can also look at as reserve adequacy. So we explore how FX reserves across the various economies stack up against the potential sources of FX stress. Now, on this front, Malaysia and Indonesia stand out as having thinner buffers compared to their past standards. So strengthening the reserve buffer will be a bigger priority for them, and that would necessitate a more cautious approach to monetary easing.
So let's say the US delays or is forced to delay its rate cuts until later in the year. How much capacity is there for these Asian central banks to hold?
I think the case for rate cuts would be stronger in places where growth has significantly slowed or rate hikes have been the most aggressive and the policy transmission has been stronger. So on the growth front, I would say Thailand, South Korea, the Philippines, and Malaysia stand out as underperformers in that growth in those places in recent years have been below the pre-pandemic range. And some of these economies have also seen the more aggressive rate hikes in the region. And in the case of South Korea and Thailand, both economies have high debt to GDP ratios. So they do face more acute challenges as recent hikes have pushed the private sector debt servicing burdens above pre-pandemic levels. So as things stand, we think that Indonesia and the Philippines will be the most cautious about pivoting ahead of the US Fed, considering their relatively more limited external buffers. And in Indonesia's case, there's also a lot less urgency to ease policy because growth there is still in line with the pre-pandemic pace, and the recent pickup in loan growth also signals scope to wait.
Krystal Tan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 6th. Catch you tomorrow with all the reaction to Australian GDP data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.